Good everyone, and welcome to our webcast today, International Relationships. I'm Justin Stallard, a tax partner with Battelle, and I'll serve as our moderator today. Speaker is Joe Dehner. Joe is a member of Frost Brown Todd and also the leader of their International Services Group. Joe gets his practice on multinational business issues and securities disputes. He counts a wide variety of companies, domestic and foreign, issues confronting global business, including transnational investment, mergers and acquisitions, joint ventures, global personal matters, cross-border tax, customs aid issues, international business structures, and distribution and agency arrangements and the resolution of international disputes. Just by introduction, the topic we're discussing today deals with international employment matters. Some of our clients and other companies are either considering international employment relationships or have already into these types of arrangements. International employment raises a number of tax, legal, and human resource issues that merit consideration before into an arrangement. From both an employer and an employee perspective. Turn it over to Joe. A couple of housekeeping items. First, everyone on the line should have received information about CPE credit. Interrupting 3 times during our discussion today to do CPE verification questions. You should have received the participant evaluation form. We very much appreciate your candid feedback in terms of the value of the presentation today. One more item before I turn it over to Joe. You should be able to submit questions in the lower right-hand corner of your screen. And as we wrap up and conclude the discussion today, we'll circle back and address as many questions as possible. With that, I will turn it over to you, Joe.
Hello to everybody. Hope you're having a nice lunch. It's noon and cold outside. So we're going to talk about international global personnel issues today, primarily from an outbound perspective. But if as we go along you have questions about foreigners who come here, feel free to pop in a question there and we'll try to address it. But we're going to focus on what is so common today compared to even 10 years ago. Certainly 30 to 40 years ago when I got started in this, and that is U.S. people who work here. They are important to the company, or they're going to be engaged to explore a new market, or whatever it be. And let's just take a look at the next slide. A couple examples. These are so typical today, and they're coming up from companies that are 5 to 10 people, from services companies to much larger companies, but very common. And we call them U.S. expats. Any expat is somebody who lives or permanently resides somewhere, then goes and lives temporarily or even permanently in a country and in a culture different from the person's upbringing. So that's what we're talking about when I say a U.S. expat. I'm usually referring to a U.S. citizen, and so a U.S. taxpayer who goes to work in some other country. Could be a long time, could be for the rest of his or her life. Could be free assignment, also typical. And a lot of different, let's go back to the prior slide, I'm sorry, just to give you 3 very common examples, and we'll touch on all of these. U.S. company sends Sally over to Brussels to manage European marketing and sales. She doesn't really have to live in Brussels. She ought to be in Europe because she'll be traveling all over the place throughout Europe, and that raises certain issues we'll talk about. Or U.S. company sends Jack down to Costa Rica to supervise their HR center that they've installed in Costa Rica or in Panama. Or a company sends Sadie over to Hong Kong to work on the after-service issues with their Asian customers. These are common occurrences. Okay, next slide. So what do you do just on a basic level as a company with these people? Who's the contract with? How do you address that? It's a very basic issue that comes up. And there really are 3 choices. One is, and it's a word that increasingly people come to understand, secondment, seconding someone, sending somewhere overseas in a certain way. And what happens there is the U.S. expat, the employee, stays an employee of the U.S. company, the country but is seconded to foreign company's affiliate, can even be an unrelated company. And what happens then is the two companies agree on who pays what for whom. So, for example, let's say the U.S. expat is going to another country, is really going to work full-time at the foreign company, and let's say is going to stay on the U.S. company's payroll. This is quite, in general, okay. But what happens then is the U.S. company has to pay, by a simple consulting arrangement, the cost of that, and the other way around. The foreign company pays the U.S. company the cost, the fair value of the person's being there in the foreign country to carry out the business. This is a secondment arrangement. Have that. You, of course, would want a probably revised employment agreement between the expat and the U.S. company because there's some new issues that pop up. And you'll also have then the secondment agreement between the foreign company and the U.S. company. So you have a contract structure there. And you have an intra-company agreement if the two companies are affiliates. So you have a U.S. company that set up, let's say, a European subsidiary. This is one way it is done. Two affiliated companies have an agreement that for transfer pricing and other reasons are fair and are going to end up. Now, there are differences. Sometimes companies use, and now and then they have to, India is an example, agreements, dual agreements. It's where a U.S. expat is sent abroad but has a contract to do some things for the U.S. company and a separate contract with the foreign company to do certain things. And so that the U.S. expat there gets a combination of compensation from the foreign company and the U.S. company. We call that the dual agreement approach. And with India, if you're going to do that and you want to have the person paid in part by this company, you have to use a dual arrangement because India insists that something be paid when foreigners are working there in India. Likewise, China, this is an issue under Tax Circular 19 issued about a year and a half ago in China. So in some countries, this is really required to take a good hard look at if you're not going to put the person on a full-time foreign contract. The foreign contract, of course, is the third kind of contract where you send the U.S. expat and that person literally becomes an employee of the foreign company. There's, of course, a variant. You could send that person over to be an independent contractor, but if the person's really an employee, I think we all know the risks of treating somebody as an employee but documenting it as an independent contractor. That raises a host of risks that lawyers don't want you to get into if you can avoid them. Okay, let's go on to the next slide. Well, in addition to the contract, increasingly we're seeing our clients and a lot of clients adopt a global mobility policy. Sometimes they're called an international assignment policy. And there, they can be 20 pages long, they can be 3 pages long, they can be part of a handbook, they can be an attachment to an agreement. Those are all details. This is an effort by companies to have consistency and clarity about what happens when you take a U.S. employee and you send them off on a foreign adventure. And forces a company then to think through the various issues we're going to cover in large part today. How to think about that, what to cover, what things to promise from a company perspective. And of course, that is done not only to be fair to an employee, but it also helps an employee be comfortable, employee and the family be comfortable with foreign assignments. Thrilling and exciting, but they also impose risks and new cultures and all sorts of problems that make people reluctant to leave the United States and live in a foreign land for some time. So there are a lot of advantages to having a consistent global mobility policy rather than tailoring your arrangements one-on-one every time as you send more and more people overseas. Contract details. Go on to the next slide. global mobility policy can cover a host of things, but we've listed here on this slide a number of the points that typically they would. Does an employee get a vehicle allowance abroad? How is that done? Is it done in general, unless you have a subsidiary abroad, you don't want to have the company own an automobile abroad, or you may be accidentally establishing a permanent establishment, so you have to think about that, work it out. Is there going to be a cost of living adjustment? The currency alone, current foreign currencies alone, aren't necessarily a fair measure of what other people use to talk about purchase power parity. There's a so-called McDonald's index. What does a Big Mac cost and what's fair? But they have a cost of living adjustment for people, can be in the policy. What about the transport of household goods back and forth? Are you going to cover that as a matter of consistency or negotiated one-on-one? In their codes of conduct, a U.S. company typically will want to maintain their ethical and other standards from within the U.S., but as you cross borders, there are other ethics that come into play, and there are other holidays, leave time, all sorts of things that come up when you leave the United States and enter another country. Health insurance is always a critical issue. Depending on where you're sending someone, they may want an evacuation policy if they have a serious health problem. You have to think through whether you're going to provide private insurance over and above the plan that they may be on. And in a lot of countries, they have a single-payer approach to health care. Children and schooling always comes up as an issue. Is an international school, is the company going to pay for it? Dependents, the spouse. Then you get into family leave, holiday matters. Are you going to provide that the entire family can come back once a year? Is that paid for? Is that a benefit? These kinds of issues. Expense and reimbursement. First class, how are you going to do it? Consistency, again, is a question. Of agreement issues. We certainly advise that if you're going to send somebody overseas, no matter why terminate such a person, at a minimum you'd promise to bring home at the end. Since with personal tax and other issues, when you send somebody abroad, you have the now two-country tax questions. Are they going to have to file in both places? These are unknowns to most individuals going overseas. So do you offer that advice as an employee benefit? You offer a particular accounting firm to work with that you'll pay for. As something that a global mobility policy would cover. And finally, we'll talk about this more later in the slides, but are going to equalize them against what could be an increasing amount of tax, because they'll remain a U.S. taxpayer, of course, though they may live abroad. But they may then be a foreign company taxpayer as well. So,
elaborating a little bit on the difference between the equalization versus protection.
That's a good question. Equalization, let's start with protection. That's the first point. Protection is you guarantee the employee that they will pay no more taxes than if they still worked at home. If there's a difference, you will protect them against that. Equalization is beneficial to an employee in a no-tax country to actually equalize the taxes, and that can result in a windfall, because taxes can be more or less in a country. Say the person, for example, moves to one of the eastern countries that has no income tax, and let's say they're able to, because of the length of stay, avoid taxes in the United States. About this, of course, beyond this hour to deal with, but the result is they have a net tax benefit. Well, you're going to let them keep it as a windfall, or will the company instead just use protection as the standard? So that's the basic difference, and that's a choice. And some companies don't mind the windfall. It's kind of a way to encourage people to go to certain places, but others take the position what they really want to do is to have the person treated as different, bottom line, than if they stayed in the United States.
Another observation I would make on this global mobility policy, a lot of clients who are in the early stages or just considering sending somebody overseas, they raise issues on sort of a one-off basis and almost address them as raised by the employee. I certainly like the idea of developing this policy and thinking through these issues in advance of sending somebody overseas, as opposed to, I think some of my clients effectively have sat there with a little bit of a blank look on their face when some of the employees come back and raise some of these issues. So definitely appreciate and advise the proactive approach to taking some time to consider these issues.
Yeah, even if you don't adopt one, it's a good exercise to talk it through, because you can then know in advance the kind of thing that the employer is likely to raise when you start sending them abroad. So I agree with that. Let's plunge ahead. Contract details. In general, we advise to try to have the expat sign the employment agreement, if it's at all with the U.S. company, in the United States. Now, why would you do that? Well, that enforces the application of U.S. law if there's ever a dispute later on. And in general, U.S. law is much more employer-friendly than foreign laws. A general statement, but oddly true. Most countries are much more favorable at termination to employees than our country. And so that's why you do that. I already mentioned, very smart to include a return to home upon termination, almost regardless of why someone got terminated. Some other considerations that aren't intuitive. Take Family Medical Leave Act that we've gotten used to here in the United States. Take OSHA, which we're all familiar with. Those don't apply outside the United States. There are express exclusions about that. So the employee may not know that. That doesn't mean you ignore these things. It means you have to think about what the foreign country safety and family leave rules are, because those don't apply to people who work in those countries. Foreign Corrupt Practices Act, to the anti-bribery approach we have, that will apply to any U.S. person sent abroad. And other rules like that are money laundering rules, all those sorts of things, will apply, and of course they get heightened when you send somebody overseas. By and large, we're a very ethical country. We're in the top 10 of the World Bank ratings on non-corrupt countries, but a lot of the other countries that people end up in have different views about Middle East bakshish or facilitation payments, this kind of thing, than we do. And that should be clear to a U.S. expat what the company expects, and beyond that they're going to have to do that no matter what the local people say the custom is. And the other point that strikes people as unusual when they haven't encountered it before is that there are a lot of foreign laws that will trump whatever you say in the contract. Take privacy. It's illegal in France, for example, to inspect what an employee is doing on the company-owned computer. So if the person's taken the company-owned laptop home and looking at whatever it may be, that's the employee's business, and the employer is not supposed to do anything about it. We can do that in the United States. So these are things, and likewise mandatory vacation rules abroad are going to apply by foreign law, no matter what you say in the contract. So just be aware that that's part of you have to think through as you send somebody abroad. Okay, next slide.
On to the next slide,
yeah.
I want first CE verification. That answer. We've talked about this at a high level, the notion that tax is critical, establishing an international employment relationship. Talk about it a little bit further as we progress through the slides. So the answer to CPE verification, one is tax.
Okay, now we're going to talk about what we would call here immigration stuff, kind of emigration stuff as you send people abroad. So foreign U.S. expats are going to need a work permit and a visa, of course, to go to the foreign country. to say it was a lot easier to get these, 30-some years ago than it is today. Just like the United States, employment, unemployment rates are a key concern in a lot of countries. And so, just like the United States, foreign countries have been a little tighter lately in deciding who can come and work in their countries. It's still, in general, a lot easier to get these abroad than it, frankly, is to get employees who live abroad to come into the United States. The point here is to get plenty of time before you want somebody somewhere to get a visa and a work and a residency permit. It can be complicated. We helped somebody recently move to France with his family, and it took. You have 3 different kinds of things to get. You have the visas for each of the family members. You've got the work permit for the individual. You also have a separate residency permit, and they all had to be obtained to make sure everything went well. You have a medical exam and all sorts of things. So I'm just saying, just plan for some extra time. Don't plan to send somebody to Europe next week. It's not going to happen, really, for any extended length of time. And we have a string of foreign agencies that we work with to achieve that kind of result. Important to work with efficient people who are used to doing this and not somebody who kind of stumbles through it. You can require the foreign entity agreement in some countries. There's a note here on the slide about it really has to do with how long does somebody have to be in a foreign country before they really are resident in that country. And most people in business are familiar with the 6-month method. If somebody is working more than half a year in a foreign country, and they're probably becoming a resident for tax or other purposes in that foreign country. But that's not the law in all countries. Some have a 4-month rule. U.S. has actually a very complicated set of rules about this. So don't just assume that it's as long as the person isn't there for more than a month that it's not going to be an issue, because it might be an issue for work permit and visa purposes. Let's go on non-competes. Again, in general, there's some states in the United States that won't enforce a non-compete. California, for example, you can't enforce one. It's a matter of California law. But most states you can, as the extent they're reasonable anyway. In general, much more difficult to enforce abroad. In many countries, China, for example, the only way to enforce a non-compete is to actually pay the person after they've left your employment a certain amount of money, and it's more than token, over time to be able to enforce the non-compete. Ties into what you put in your contract about how you're going to resolve disputes and what law applies. And speaking of law applies, what labor law applies? You send somebody, let's say, to Germany to live there 3 years to run your European sales, let's say. Well, you might keep that person on the U.S. contract basis, as we've talked about. Does that mean German law is irrelevant? Well, no. Germany will take the position that some mandatory rules in Germany apply, because after all, the person's an employee working in Germany. There are some recent cases out of the United Kingdom which are really quite interesting. One simple one involves a law firm, actually, in I think it was Tanzania, one of the African countries. And the Tanzania firm got acquired at some point by a UK law firm. A woman from Tanzania sued, claiming she'd been the victim of discrimination. Tanzania apparently didn't have good anti-discrimination rules, so she sued in London, claiming the UK law applied. Well, she'd never been to London, but for a Tanzanian company that had been acquired by a UK company, and the court held, well, that was a substantial connection with the UK, so she could use the UK rules to get compensation for what she would not have won out of Tanzania. It's just an example to say you have to think through carefully what labor law actually may apply if there's ever a dispute with somebody. And can be mandatory payments in a foreign country that apply regardless of contract. Germany, for example, by law, once somebody's beyond a probationary period, you have to pay that person. You have to give that person at least 6 months' notice before you can terminate them. What happens generally in Germany is people often pay out the contract then by at least 6 months' notice, and then it can be more if the person's worked longer. I won't talk about it much here, but I will mention there are people who become international commuters. We just had a company deal with this fact pattern. A German citizen who lived in France working for the U.S. company for 12 years who decided he wanted to live in South Africa. So now he lives in South Africa. He's a German citizen working for the French rep office in South Africa for a U.S. company. Well, what law applies? Unless you're careful about it, maybe all 4 sets of laws becomes quite a mess. Discrimination laws, as mentioned with the UK example, can trump whatever the home country or country law may be. So it gets more complicated.
Before we move on, I want to spin with this question. We have discussing on this slide in international employment relationships, it is often unclear whether home country or host country labor law applies. So the CPE verification question number 2 is labor law. Again, labor law.
Okay, well let's talk for a minute from a company perspective now. A lot of this has had to do with company employee type considerations, mutual consideration. This one's a company issue. Let's say a company sends somebody to a foreign country, does not set up a subsidiary, does not register a branch. That can create what we call, in general, the permanent establishment of a foreign presence. And you haven't registered and you haven't set up a subsidiary, that can cause all sorts of trouble because you haven't registered, you're not withholding, you're not paying into the new different country's system, these issues. So in general, until you're ready to set up a branch or a rep office or a full-fledged subsidiary somewhere, the company wants to avoid that problem. It should not accidentally have a permanent establishment. And by the way, that isn't the sole definition of what can create a taxable presence, but we're using that as shorthand here. Whether a permanent establishment occurs in a foreign country is not something by world government. We don't have world governments. It's all country by country, and there are differences among countries as to what will create a permanent establishment. And it often is related to work permit and immigration issues when somebody moves there. Obviously, setting up a foreign subsidiary will limit the liability of the U.S. company because that's why you have a subsidiary. It's a limited liability principle. You've risked the capital you put into it, but then you avoid the permanent establishment for the U.S. company. You have a branch, a rep office, and it can be a form of branch. Of course, use there because when you have a branch, it's going to be you're going to have to account for it as a branch in the foreign country. Then that means your company's full assets are at risk in that foreign country. You haven't limited your liability, and that may mean that the foreign tax authorities are free to see the books of the company. And you may not want that to happen, so very often people avoid a branch, companies avoid a branch, if they have a presence in a country. The office is an exception to that. Now, rep office is a presence in a foreign country that only does sales and marketing, and that's a widely used idea, and that doesn't put at risk all the assets of the U.S. company. But what we don't want is an unintentional branch, as I mentioned. Let's go. I'll briefly touch on pay limits and clawbacks. This come up in the last few years after the commercial crisis we had. mortgage crisis, whatever one wants to call it, a few years ago. And the whole issue of pay limits and clawbacks. I won't talk a lot about it because probably a lot of you, your companies on the line won't watch this, but financial institutions do, other people do, and this can interfere. The foreign laws can and the U.S. laws can with what's in a contract. For example, limited the amount of deferred compensation that could be promised to bankers. There can be potential forfeiture of long-term deferred comp by law. A couple foreign examples, Deutsche Bank, for example, under German law, anything over 200,000 euros compensation to its employees has to be deferred. In the United Kingdom, there's recent change of law where the shareholders were given clear power to reject pay packages to executives, no matter what the company and the executive may have contracted. So these are things we're beginning to see more and more, and with top flight executives, it's something to take a look at and be aware of. Language, the next slide. Problem, you may be required to translate an English language employment agreement, even if the employee is okay with it, a foreign language. For example, if you're a country that requires registration or requires a work permit, they want to see in French, let us say, what the agreement says. And so you'll have to translate this, and it's easy enough to say, oh, I'll just send that out to some translation provider. That's fine, but be careful. I'll give you an example. We had a French language agreement that a company had translated into English, and in France, in French, it really said contract of indefinite duration, which after a probationary period is what happens in France. The translation was permanent employment agreement. U.S. people would shudder. We don't have permanent employees, surely. Well, in France, that's sort of what happens, but permanent was a terrible translation. It really was contract of indefinite duration. It wasn't a lifetime contract. But it's just an example to say make sure you're getting a good legal, what we call legal translation of agreements, so to avoid problems later on if there's a planning. This is a tricky one, and we certainly aren't going to go into much detail here, but it's just to say be sure to review your pension and benefit plans to ensure continued eligibility when persons work abroad. If you have a health plan or a pension plan, it may not say the way it's currently worded that it applies to people working inside the United States. You must consider the impact on your existing pension plans in relation to your U.S.-based plans. Or you can end up with expecting continuation of something that turns out doesn't exist. Equity plans, thing that is getting a lot of attention. You promise stock options, or you have, of course, the U.S. securities rules and approaches to apply, but then you enter the foreign rules. And clawbacks, as I've mentioned, these are all things that implicate not just the U.S. laws that you all are familiar with, but foreign rules. And more interesting when you're talking about foreign employees that you may engage abroad, because in general, again, this is a gross simplification, but most foreign employees are more interested in immediate cash than they are long-term equity. And we see in a lot of the larger companies, Procter & Gamble, for example, is trying to get the world on more of a long-term view of company value. But it struggle in places that will tax stock options right up front for people living abroad, and don't the favorable view of equity plans that the United States does. Well, let's get into taxes. And we start with the question Justin was asking about earlier, equalization versus protection. Protections where the U.S. company pays the extra to protect the employee. you want to do that individually, person by person, generally, practitioners in the area will tell you consistency's the better approach. That's so you don't get grumbling among employees who inevitably talk to one another. How are you dealing with this or that? And one finds out that one's being treated one way, and the other finds out, the opposite. And so, in general, companies try to be consistent with their employees on whether they're going to use equalization or protection approach. Of course, you've got to consult with astute foreign tax counsel and accountants. And I know Battelle has a great international network that it's part of, and has really good accountants that they work with all over the world. And that's really critical to make sure that the way U.S. Professionals looking at it is the same way that the foreign professionals looking at it. Deferred compensation. You send a U.S. expat abroad, the relatively still newer rules of 409A of the tax code and 457A, in general with deferred compensation arrangements, and not they're immediately taxable, they'll apply because even working abroad, a U.S. person, a U.S. citizen, is a U.S. taxpayer. And so those rules still apply. And we don't have time to get into the details, but FBAR and FATCA cannot be ignored. Now, in general, FBAR and FATCA deal with anybody who, I'm greatly simplifying, but anybody who controls a foreign bank account, has signature authority over a foreign bank account, holds assets of more than an amount abroad, and as U.S. expats move abroad, they're likely to have bank accounts and other assets that mean they have to answer their tax return differently than they used to. So you don't want them getting in trouble, and you certainly don't want the U.S. company getting in trouble either. FATCA is effective just this year, coming up in full force with federal institutions. But a little known part of FATCA for any of you who have treasury centers or other financial centers outside of the United States, even though they're not a bank or a securities firm, they're covered by FATCA also. So this is something just to be aware of and make sure you're compliant come your stay.
Joe, a couple more comments on the FBAR side, and really impact different parties. In the arrangement, you could have an employee that has signature account or signature authority on a foreign bank account. You have a company that has control over a branch or subsidiary with a foreign bank account. That would create a filing obligation on the part of the company of a foreign bank account report. And then you also have an executive back here in the U.S. They're going to have signature authority over the account. So when we talk about the FBAR, these foreign bank account reports, keep in mind that there are three potential filings. One, the expat employee, potentially with U.S. exec, and also one with the U.S. company. And failure to file these carries pretty significant penalties with it. And IRS recently is starting to actually impose these penalties for failure to file this form.
Indeed, they are, Justin. And I'll just add to the complexity. That's what I mean. If they're not working with you all on this already and don't know all the rules themselves, they really must. The other thing with it, sometimes you have to file both FBAR and FATCA filings. You say, well, I took care of that. I did my FBAR filing. And, oh, yeah, but you didn't do the FATCA filing. And so it's really a tricky area, and there'll be a lot of kind of unforgiving fines issued. And what is it? Sometimes they're $5,000, $10,000 per event fines. So you don't want to have those surprises. Okay, well we're rounding the bend here. U.S. citizens abroad. I think everybody on the phone knows that a U.S. Citizen is a taxpayer, and we tax on worldwide income. But the U.S. taxpayer is also entitled, in general, to get foreign tax credits, and that's under the idea of foreign tax treaties. And we're going to talk a little bit about that. So let's go to the next slide to set up the point. Let's say that somebody's terribly uninformed. A U.S. company is going to send bill over to Singapore. was thinking, well, I'm moving data, so I don't have to file my U.S. income tax. I don't worry about Social Security and Medicare anymore. And obviously, I think we all know on the phone that that's not right. So what is Bill's reward for moving to Singapore if he doesn't think about it and the company doesn't help him? Well, he still owes his U.S. federal income tax, still pays FICA, and also owes Singapore income tax and Singapore social taxes. Now he's double taxed. This is the tax whammy if not properly addressed. So here are points about it. The first one is that foreign tax credits, let's go back to, there we go, tax credits to a large extent will prevent double taxation. So if Bill is paying income tax to both Singapore and the United States, he'll pay to Singapore, he's working there, right? But he's going to get a foreign tax credit for what he pays in income tax in Singapore. Singapore is one of the lowest tax places in the world, so he'll still owe U.S. tax, but he'll pay something to Singapore and get some offset, and therefore will pay yet less to the United States IRS.
Just a comment on that. We've talked about the foreign tax credit mechanism from an employee perspective. Keep in mind that to the extent we have permanent establishment in a foreign jurisdiction, all have the same dynamic from an entity tax perspective, where we could be paying tax in the foreign jurisdiction. There's planning and structuring considerations need to be taken into account on the entity side as well.
Oh, absolutely. And we're not focused on that today, but well said. So the U.S. allows a credit for qualifying taxes paid to foreign countries. Not state taxes, not other things, but income-related type taxes. And a foreign tax credit, which applies to any country under the U.S. tax code, ensures that U.S. employers are not subject to market distortions when they're sending workers abroad. Now, you go back to the prior slide, I'm sorry, because we're going to talk about, there we go, double tax treaties. The U.S. has 68 tax treaties. In other words, 68 countries we have double tax treaties with. They most commonly address the basic income tax of companies and individuals. The idea here is, and these are broadly with the more developed countries in the world, virtually all the countries in Europe, Canada, this sort of thing, and basically ensure that citizens and companies are only taxed once. It's where we have relative reciprocity from a wage standpoint and other standpoint with other countries. That's very beneficial because it avoids foreign tax residency issues and allows only the U.S. tax regime to apply to the extent U.S. is the taxpayer, and vice versa. And so when you're sending somebody abroad, one of the first things you look at, or have your accountant look at, is the double tax treaty. Is there one with means we don't have foreign tax treaties with over 100 other countries, and that's where you get into the double taxation problems. The foreign tax credit to help. Go ahead, Justin. Yeah,
a couple things. First of all, there are tax treaties out there on irs.gov. That's the good news. The bad is if you're not used to reading these treaties, it can be very difficult to decipher exactly what they mean. And on top of that, even if you do Google a tax treaty to try to figure out the tax consequences, there can be provisions buried a little bit deeper in these treaties, things like the limitation on benefits clauses, that can be the answer that you're coming to. So my advice to you at the end of the day on the tax treaty front is get in touch with a professional. Obviously, our clients are working with us on this, but this is not light of heart to try to dig into a tax treaty and figure out the ramifications.
It's not for the amateur. And then Social Security, that's the next slide. And I'm talking about sides. But Social Security taxes are the same way. Now, what is this about? Well, you send a U.S. expat abroad, and to the extent they're taxed in that country and living in that country, for example, requires anybody working in China will participate in the Chinese Social Security system. And double tax treaty, and we have no totalization agreement with China. Well, what's a totalization agreement? Those we've worked out with 24 countries, and they basically theoretically allow, say with Holland, we have one with Holland, that will allow a U.S. company to bring a Dutch person here or a U.S. person to send somebody to Holland and stay within their home country Social Security system. This is what a lot of employees want to do. They don't really want to participate in some foreign system that they're only going to live in for 3 years and never get any benefit from. So that's what these totalization agreements are about. Company perspective, later in the slide you see there the 3121L election allows affiliate by affiliate. In other words, it's not for all of a company's subsidiaries. It can be affiliate by affiliate. Unless the laws change, there's discussion of that. But it can allow you to say, okay, for all my Dutch expats that are working for my Dutch subsidiary, I'm going to keep them all in the U.S. system. But we make otherwise you can do it individual by individual. But if you do the 3121L election, then the U.S. company will pay all of the FICA, in other words, the employee's part and the employer's part. That can be a great advantage and may help assure and is a benefit in a way, of course, to net to the employee. But it's something to think about. Okay, let's go to the next. There's some other tax issues we already mentioned. That the deferred comp rules, the 409A rules. Those are quite complicated, and like as Justin said before, that's not for the faint of heart or the uninitiated. But if there's deferred comp, I'll make sure it doesn't hit. It's not unfair immediate tax burden for someone you're sending abroad. And 457A has to do with fund managers on deferred comp. Probably nobody on the line is a fund manager. We can talk offline, but the point is that these apply to U.S. expats. Not just work in the U.S. And the other relatively small, but it's increasingly on the uptick as all over the world, cities and states or provinces struggle for tax revenue. This is very much on the uptick because the expat can still be liable for state and local taxes, both back in the U.S. or abroad, no matter what the double tax treaties say. So you really have to be careful here. I think we probably on the phone are aware of a lot of U.S. cities, entertainers when they're sports figures when they come to town for one day. This is the problem I'm talking about. So you send somebody, even for some time, somebody to commission a piece of equipment or something abroad. It can raise state and provincial or local tax issues abroad. Just in here. Okay, just a couple more slides to go. We're right on time, I think. Report requirements, we've mentioned FATCA and FBAR, just a little more detail there. FATCA is requiring reporting of financial assets with an aggregate value of over $50,000. And FBAR, it requires the filing as well as a check in the box on the tax return related to overseas financial accounts of over $10,000. Those are relatively low thresholds that are going to catch an awful lot of companies and individuals. And the last comment, and then we'll just open to any questions or comments, Justin, and you may have on the phone. Just what we call tail risk. Now, this is one last planning thought. Let's say this company wants to hire a foreigner. Here it's Raphael down in Peru to, let's say, do sales and marketing, but really full-time. Say, in fact, if you really squeeze all the water out of the towel, Raphael's an employee. He's working full-time. You don't want him moonlighting. But you don't want to have a branch in Peru. You don't want to have an independent contractor. You don't want to have a subsidiary in Peru. You just want to hire a guy and not have to worry about all this stuff and let him pay his own taxes and so. This is a very common thing we're seeing. That's the desire. Instinct. Well, we'll set him up as an independent contractor. And sometimes that can be done. Sometimes U.S. companies can have employees in a foreign country and avoid a permanent establishment. Don't do it without talking to your local professional. But it can be done, and it can be the answer because setting up a subsidiary or branch or rep office has, of course, costs and ongoing costs associated with it. And if you can avoid them, great. But what's the risk? That's what I call the tail risk. So you engage Raphael. Let's say you sign up Raphael as an independent contractor in Peru. It's there he's going to pay his own taxes, and there's going to be no withholding, and it's all his problem, and you pay him a nice amount. And then let's say 10 years later, there's a falling out of some kind. You don't need him anymore, or you're lazy, or whatever it may be. And so you terminate Raphael, and then he goes to labor court in Peru and said, well, I was an employee all these years. And should have been doing withholding, and they should have been doing this, and they should have registered. And let's just say Raphael never did pay his taxes because his position in labor court is you should have been doing the withholding all these years. That's what we call the tail risk. And the planning we've talked about already in the slides, done right, avoids that tail risk. Or at least that's its intention. Maybe you can never absolutely prevent a tail risk, but you can do it in advance, of course. And I think I'm at the end of my slides, so you pipe in here and any questions.
One more observation on the tail risk slide, Joe. You mentioned paying taxes if they were to withhold by the U.S. company. Mm-hmm. I guess for the listeners on the line, it's important to think about that both from an income tax perspective, also the equivalent of the local country Social Security. If this person's I'm just talking about one type of tax here, you're potentially talking about risk from a number of different perspectives.
That's exactly right, and it's just like here we get used to unemployment and workers' comp, the two common ones on top of FICA and income tax. Likewise, other countries it can be very complicated. I think in China, in some provinces of China, you have like 11 separate taxes. There's a housing tax, and one province there's an earthquake tax. All this stuff that if not properly addressed can become a part of a tail risk. Exactly. Yeah.
We'll go ahead and pose the last CPE verification questions. We've talked a lot about the importance of tax treaties in evaluating the income tax consequences of an international employment relationship. So the answer to CPE verification question number 3 is tax treaty. Tax treaty. With that, I do not see any questions in the queue, so that concludes our presentation for today. We have contact information on here. If you do have questions that you did not get a chance to pose, please forward those directly to Joe, or you can forward them to us, and we will get in touch with Joe. That will conclude our presentation, and we appreciate everyone's participation. Thank you very much.
Happy holidays.